I'm John Olin. Welcome to Bloomberg Markets.
And I'm Matt Miller. Let's take a quick look at the markets at this hour. Right now, not a lot going on in equities. We have the S&P 500 down, but only about 0.1% right now. 44.11 is your level. The U.S. 10-year yield also barely budged at 4.6419%. The Bloomberg Dollar Index at 1264, 1265. Really, the only mover on this screen is NYMEX crude, which is currently up just 89 cents to 78.06 a barrel. So, John, it does feel like we're waiting for some data, and we're going to get that this week in the form of CPI.
We certainly will, and we'll talk about it in a second. I mean, it's interesting when you go under the hood, even though broadly speaking, it's a challenging day for technology stocks within the Magnificent Seven group. You've actually seen a couple of standout names today. Right now, NVIDIA shares are up again, 9 days of advances. Could be the longest streak since 2016, providing more high-profile AI chips. Seems to be keeping that AI rally alive. Tesla's also up today, around 3.5% in early trading. Helps when we look at what companies are saying. The outlook from Tyson right now, Matt, somewhat soft, and so we have seen that food giant with stock performance today that's been a little bit more mixed. Right now, Tyson shares are off close to 4%, and it's going to be a busy week on the retail front, including Home Depot as we move into tomorrow's trading session, and you have to wonder how this interest rate environment is ultimately going to impact the kind of business that they're getting, so we'll find out when Home Depot reports its numbers.
All right, looking forward to those reports. Let's move from equities to the broader economy. Strategists over at UBS are now saying that the Federal Reserve will cut interest rates by 275 basis points, nearly 4 times what the markets are pricing in. Bloomberg's Abigail Doolittle is here with the details. Abby?
Yeah, Matt, this is a pretty dramatic call. I mean, if you think about it, that's almost saying that rates will be 3% lower around this time next year than they are now. Now, the justification that UBS is using is they're saying that they see this as a normal rate cutting cycle ahead. So again, they expect 275 basis points by the end of next year. They think that we could start to see cuts as early as March. And then they're saying that one of the reasons inflation's down, I don't know that this is a justification, but they do see a recession starting by the second quarter of next year. So when I have thought about why would the Fed potentially cut sooner than the Fed is saying that they might cut if there was a recession around, that could be one reason. Now, when you put that 275 basis points against the market, which is basically at 75 basis points by the end of next December, it's a really wide divide. But the widest divide, Matt, might be markets and strategists versus the Fed itself, because the Fed on at least 2 occasions has said they're not cutting anytime soon. In fact, if we go into the Bloomberg terminal and we take a look at a chart that shows the 2-year yield and the 10-year yield, here's the 2-year yield. It's a weekly basis. You can see the uptrend is in place. The 10-year yield, the uptrend is in place. The 2-year yield very firmly from a number of technical chart perspectives, Matt, looks like it's going to continue to go higher. The 10-year yield, maybe a little bit less so, but if the 2-year yield does hold that uptrend, it would very firmly suggest that the Fed is less likely to cut. But again, we have lots of strategists right now talking about big cuts to Fed funds rate next year.
Yeah, absolutely. I mean, you've got Morgan Stanley as well, which thinks that the Fed will cut to 2.375%, so between 2.25 and 2.50 at the end of 2025. But UBS looking at a terminal rate in their forecast of 1.25% on Fed funds by early 2025. That's very, very bearish, the U.S. economy. Earlier, J.P. Morgan's Thomas Kennedy explained why Wall Street sees a slowdown in economic growth, which could lead to those rate cuts.
We're expecting a growth slowdown pretty much like the rest of Wall Street at this point. And it is relatively simple and intuitive. You have the cost of capital above expected revenue in this economy. And if you think about America as one big business, it's very odd to see the cost of capital to be above expected GDP. It should force investors to say, maybe I'll just save instead of borrow money and invest in my business. We've seen this 4 or 5 times in the last 40 years. Just about every time you see a growth slowdown.
Let's bring in Lydia Boussour, EY-Parthenon senior economist. So Lydia, there's a lot of bearishness out there, especially considering the fact that we just saw a 4.9% print. We're looking at consumers that are spending more money, even when you remove inflation, than they were in 2019. So why are we so worried?
Well, the economy is facing some fairly strong headwinds, and we've seen a lot of resilience in economic activity over the summer. But as we look ahead, we are in an economic slowdown, and the environment is turning less supportive. The consumers are going to turn increasingly cautious with their spending. They are still facing elevated inflation, but also the pressure from higher interest rates. We are also seeing, we've seen a rapid drawdown in excess savings, and we are also seeing some erosion in consumer balance sheet. So we are expecting to see that downshift in consumer spending, but more importantly, the labor market, which has been a key pillar of strength for the consumer, is also going to soften, and some deterioration in labor market conditions are expected as well. So as we head into 2024, we are in the camp that growth is going to fall below trend for a number of quarters. We are seeing growth below 1% throughout the first half of next year. And we are also seeing a modest rise in the unemployment rate as this rebalancing in the labor market continues.
So what is the Fed going to do to respond, Lydia? Because, you know, in the University of Michigan survey, consumers see inflation at 4.4% out 1 year. I imagine you don't think inflation is going to surge back up again. How can the Fed deal with the slowdown in the economy?
So we're looking at our outlook is for inflation to continue to moderate going forward. We do think that the conditions are in place to continue to see that disinflation process. So we see core inflation ending the year slightly above 4%. We see headline inflation also continuing disinflation well into 2024. And we think that the Fed is going to be well positioned to remain in wait-and-see mode and on the sidelines. So we do think that the Fed is essentially done with its hiking cycle. It's not going to say so. It's going to be maintaining that hawkish bias and essentially keeping interest rates higher for longer. So I think at this stage, the bar is high for any rate cuts. You mentioned some aggressive calls for rate cuts next year. We see a more gradual process. We see, 75 basis points of rate cuts next year, and the first rate cut happening in June of next year, and extending into 2025.
And just to build on that, Lydia, because the inflation story will remain elevated through the first half of next year?
In terms of inflation, we are expecting to see that continued slowdown. So by the middle of next year, you're going to be looking at headline and core inflation, at around 2.5%, drifting below 2.5%. I think what's important to keep in mind looking at inflation is that it has surprised many observers to the downside this year. And our view is that looking at 2024, we are also thinking that inflation is going to be surprising many to the downside. Why? Because we are expecting to see a rebalancing in the labor market leading to moderating wage growth, because we are also expecting to see that softening in economic activity with slower demand for goods and services, and more housing disinflation as well, which is still in the pipeline. So all of these factors are going to be combining to push inflation lower. And by the end of next year, we're going to be looking at headline and core inflation closer to where the Fed would like it to be, even if not, at the 2% target yet.
Yeah, I guess what I wanted to get at was if you're seeing the possibility for rate cuts next year, but likely not until the second half of the year, what's happening in that first 6 months of the year that perhaps keeps that hawkish commentary coming from the Fed in the interim?
Sure. We're looking at a labor market that's still relatively tight, and we're looking at a core inflation that's still quite elevated. So the Federal Reserve still thinks that there is more work to be done. So they are really committed to be keeping, interest rates at that restrictive level for some time. So what we're expecting to see in the first half of next year is essentially a continued rebalancing in the labor market and moderation in wage growth, but also a continued slowdown in inflation. And until the Fed is convinced that inflation is moving sustainably towards that 2% target, they are going to be maintaining that hawkish bias and maintaining that higher for longer policy mantra for the first half of next year.
Lydia, what do you think happens with federal spending? I mean, we are running a $2 trillion deficit this year, and maybe that hasn't got as much to do with the surge in yields that we saw, at the beginning of last month, middle of last month. But can the federal government continue to spend that much money? Do we need to spend that much money to keep the inflation humming along?
Yeah, so there is renewed concern about fiscal sustainability in the U.S. We are also seeing, the risk of a government shutdown with the Friday deadline. So this is an increasing, risk for the economy, especially in the medium run. So there is certainly a need to put, the fiscal picture in the U.S. Back on a sustainable path, and this is going to be something and that we're going to be closely looking at in the coming year and into 2025.
Lydia, thanks so much for joining us. Lydia Boussour there, EY-Parthenon, senior economist, talking to us about the U.S. economy. Coming up, a new study on Novo Nordisk's weight loss drug shows it could reduce the risk of heart attacks as well. More on that next. This is Bloomberg.
This is Bloomberg Markets. I'm John Ehrlichman with Matt Miller. Time now for our Stock of the Hour segment, and we've been keeping an eye on shares of Novo Nordisk at this hour. The stock rebounding after some early weakness. A new study finding its blockbuster weight loss treatment, Wegovy, can also reduce heart attacks and deaths in people with obesity and a history of cardiac disease. And now we're fairly upbeat on the news today. I know we saw some choppy trading, Matt, but that's been the story of the year for companies like this. Novo Nordisk shares up in the neighborhood of 50% this year on the optimism around the potential market size for these types of treatments.
Yeah, and this is kind of it in terms of these drugs, right? Novo Nordisk is like the NVIDIA of GLP-1s. There are obviously competitors in the market with slightly different drugs and others, semaglutides, coming out. But right now, Novo Nordisk owns this market. Let's talk to Madison Muller. She covers the health sector for us. And Madison, this is interesting to me because, okay, you would expect a drop in cardiovascular problems just through the sheer loss of weight, right? Because obesity adds to cardiovascular troubles. But they're saying that this is something beyond that, that it's actually more heart healthy than just weight loss alone.
Yeah, and I think that that's the interesting story that we're seeing play out right now. We actually don't know how exactly that's happening. Like, cardiometabolic conditions are very interrelated. Obesity is a risk factor for heart disease. And so it makes sense that for people with obesity and with a history of cardiovascular disease, these are the people in this trial were quite sick. Like, they've already had a heart attack or they have a, established history of cardiovascular disease. So Wegovy helped prevent a second, attack or a second event from happening. But what experts are saying is that not all of this can be attributed to the weight loss alone, that there's something else going on with these GLP-1 drugs like Wegovy and like Eli Lilly's Zepbound that might actually have a benefit beyond weight loss.
Now, are there any others that are already in the market that people are taking? I know that Lilly has competitors in the pipeline, but have they been approved for use?
So Eli Lilly had Mounjaro for diabetes, and a version, well, it's actually the exact same drug, was approved for obesity last week. So that's called Zepbound, or 2 weeks ago. So that's newly on the market, but we've seen a lot of off-label use with Mounjaro, and it's the exact same drug. It looks to potentially be even more effective than Wegovy, and so they're definitely the number one competitor to Novo Nordisk right now.
Madison, when we're trying to figure out ultimate size of market, to your point, it's early in this cycle. I think historically, if people thought about weight loss treatments, they weren't necessarily committing to that for years. As more of this research is coming out about improving your odds against, let's say, a heart attack, how long of a commitment are people having to potentially make to these treatments as users?
Right. Well, that's the thing, is that these drugs are supposed to be taken for the rest of someone's life. I mean, that's when people go off of these drugs, what we're seeing is that they regain gain that weight back, and that might also increase the risk for other health issues. And so ideally, a person is supposed to be on it for the rest of their lives, but we're seeing between, spotty insurance coverage, shortages, side effects, people aren't taking them for many years. And granted, these drugs are new, but we're already seeing some discontinuation, I think, sooner than maybe is expected. And so it sort of remains to be seen what's going to happen in terms of long-term usage with these drugs and how that plays out.
I was talking with Lars Jorgensen a couple of days ago, the CEO of Novo Nordisk, and I asked him about the pill form because I don't really want to be injecting myself weekly. He said many patients actually like the weekly injections. Yeah, I'm not sure if I buy that. Yeah. Is someone going to come out with a pill that works just as well? Because I know they have like Ribelius or something, but it doesn't have the same, success.
Right, and that's exactly right. I mean, that's what's coming. Novo Nordisk has already submitted in the EU approval for a higher dose version of Ribelsis. They're planning to submit in the US in 2024, but Ribelsis is not as effective as these injectable versions, and so they're testing doses that are 2 to 3 times higher dose than the currently approved version of Ribelsis to see if that will help. So we could have oral weight loss drugs soon from Novo Nordisk. Eli Lilly is a little bit further behind, but also developing an oral pill. So is Pfizer, so is AstraZeneca. That's kind of the next frontier in this weight loss market.
Yeah, it's a pretty incredible growing market, Madison. You do a great job breaking it down. Thanks very much for the insight, Madison Muller from the Bloomberg team. We'll continue to track that story. We are also tracking shares of Boeing today, getting a nice pop after a bunch of new orders. We'll have those details next. This is Bloomberg.
Anytime there's dialogue, direct dialogue, that's a good thing. But, we've been in China for 50 years now. We've been with our customers. Interestingly, last week, the 95th airplane, the MAX that was on the ground, came back. So they have all 95 airplanes flying. We're in the middle of preparing deliveries for the new MAXs. And I'm optimistic about the discussions.
That was Boeing Commercial Airplane CEO Stan Deal speaking earlier at the Dubai Air Show and expressing optimism about talks for a 737 MAX order from China. In addition to that, for what it's worth today, how about $52 billion, Matt? The list value for the aircraft Emirates is purchasing from Boeing. Just one of the aerospace giants wins, and that includes upwards of 90 of its 777X model, 5 787s, and the shares benefiting on that news today within the Dow, but also this idea of a freeze in China coming to an end based on some of that Bloomberg reporting is another key factor that's been driving the stock today.
Yeah, a lot out from Bloomberg News, but what the bottom line is, there's a huge order for these 777s, and I'm excited, to get away from these narrow-body, cramped little A320s and 737s and get back into a big plane that feels more like a 747 that we all want to fly in anyway. Let's discuss with Bloomberg Aerospace reporter Julie Johnson. She's out in Chicago. Julie, tell us about, this order, and if I put in an order for a 777 today, when am I going to actually be able to take delivery of the plane?
Well, that I don't know. The plane's not in service yet. It's really been run through the gauntlet by regulators in the U.S. and Europe. So hopefully it'll start coming onto the market in 2025, and so it's going to be a while before enough of those are in service that you run into them regularly. Huge. That's a huge win for Boeing. Big endorsement. And the bad news. The ultra large planes are a little bit out of favor with airlines. The MAX. And
not with passengers,
planes.
those, Julie. I'm 6'4", 220. I got to ride in a big plane.
Hey, I love them too. But honestly, the two announcements, the China one they're both huge wins for Boeing. But if this China deal comes through, this is just massive in terms of getting Boeing on solid financial footing.
And also, Julie, I mean, the fact that this could be, as your reporting would indicate, at the center of easing tensions, if you will, between China and the U.S. as we get ready for the meeting between the president, Joe Biden, and Xi Jinping. Real quickly, what do we know about how this started to come together ahead of that key meeting?
Well, I think the U.S. has been working this for at least a couple of years, and frankly, you know, aerospace is one of the few areas where the two countries have complementary interests. Like the Chinese need our planes, and the U.S. has had a trade surplus to China up until recently for a very long time. So this is a relationship that goes back to 1972, I think, when Nixon arrived in a Boeing 707, arrived in Beijing. So anyway, it's really significant, and China domestically wasn't traveling until this year on a large scale. You know, they were still locked down, and so now they need their planes, and by the way, the world is selling out of 737s.
Yeah. All right, Julie, thanks so much for joining us. Bloomberg's aerospace reporter Julie Johnson there out of the Windy City. For John Ehrlichman, I'm Matt Miller. This is Bloomberg.